Well, the Federal Reserve announcing today is repeating a financial crisis policy move to create a commercial paper funding facility to support the flow or credit to households and businesses. And we have seen a bit of a pop on the back of that in the markets today. In addition, we heard from the White House, specifically Treasury Secretary Mnuchin today in an afternoon press conference talking about additional stimulus that the administration is currently looking at that has led to what we're seeing here on the Dow right now. 21,161 is the level we are looking at, up 940 or 900, more than 900 points there. Brian Cheung is here with us at the desk to kind of break down what we have been seeing here. It's tough to tie the moves we're seeing there directly to what happened with the Fed. Certainly a number of headlines coming within the hour, but how significant was this move that we saw this morning? It
was significant, but it was actually expected. So the Fed announced a number of tools in that surprise Sunday announcement, right? In addition to slashing rates to zero, it also announced $700 billion of quantitative easing and then a number of other measures with regards to bank liquidity and capital. But one specific concern was that all of those types of transmission mechanisms that the Federal Reserve had announced wasn't really doing anything directly to address the stresses that we've seen in the corporate debt market. And one short-term corner of the corporate debt market is commercial paper, right? This is short-term unsecured debt that companies of all different types of industries will issue to get short-term funding for anything less than a year effectively. A lot of commercial paper is actually 90 days for only 3 months. And there was concern right now that a lot of people and a lot of broker dealers and banks are just kind of sidelining themselves amid the market volatility. So companies have no one to turn to when they're trying to offer the commercial paper. So the Federal Reserve announcement today is saying that they'll be able to renew corporate commercial paper that's issued, which would be a direct relief to any sort of company that's really looking for relief as they try to map out how they're going to get through the coronavirus over the next few months. Okay, let's bring in Danielle DiMartino Booth. She is with she's the director of intelligence for Quill Intelligence. Danielle, good to have you on today. You heard what Brian had to say about the Fed move today. Your reaction to what we saw?
Well, I think right now we're seeing the Fed in the fastest mode that I've ever seen them. This is turbocharged Fed policy. And the good news is there are so many different facilities that were rolled out during the financial crisis that at the New York Fed in downtown New York, all they literally have to do is dust off the old facilities and roll them out one by one. So as they see stress, I think we're going to continue to see these facilities get reborn, and that's what's important. Clearly, there's somebody there in New York. There are people in Washington, D.C., and Powell himself is very familiar with private equity, with the debt markets, with hedge funds. So he understands the inner workings of these markets on a personal level and is able, I think, better than his predecessors to be able to address stresses as they emerge in the credit markets, which is really critical given the feedback mechanism we've seen between the credit and the stock markets.
Yeah, let's be real. I mean, everyone was quick to bash Chair Powell here, too, though, right? When we saw the sell-off on Monday, and I'm not sure how fair that was, considering there's only so much you can do from a monetary side, and we're still waiting for the fiscal measures here to come through. But he is pulling a lot of the same levers we saw back in 2008, this last move in the commercial paper market space, the latest lever, to also align with what we saw play out back in 2008 in the financial crisis. So curious to get your take on how serious it is when we think about that spread specifically there, since we saw the same thing back when we broke the buck. If you remember what happened back then. I mean, it's strange to see everything playing out, though it's such a different crisis we're dealing with here.
It is a different crisis, and I would be clear to point out that we really haven't had a Lehman moment. And this is something that we've been really debating in my inner circle is what are the differences between now and what we had in 2008? The speed and the violence with which we've seen these moves. We've had the fastest 10 and 20 and 30% correction in U.S. history that have played out in a matter of weeks in the United States. But by the same token, we really haven't had a systemic risk moment yet in the credit markets. Now, what they've rolled out today is overnight funding relief. And what remains to be seen is whether or not, if you go out further on the time spectrum, given the tremendous amount of refinancings that have to be completed in the high yield, in the junk market this year, whether or not the Fed is going to see fit to extend out the time frame that it's offering liquidity on an emergency basis.
Danielle, Brian Cheung here. So when we're talking about going forward, what more the Fed could do, seems like they have not yet unleashed the term asset lending relief program that they actually had in 2008. There were some questions, too, about whether or not they could further lever their balance sheet with quantitative easing because they haven't necessarily committed to a certain amount of purchases per week or per month, per se. What would you expect from the Federal Reserve if you were to, say, see conditions deteriorate further in either money markets, treasury markets, or in the credit markets?
Well, I think you have to look back, more importantly, at what happened on Sunday night in order to look forward. The primary opening up the discount window to small and medium-sized banks is really critical because they can park a loan. They can park a bond. They can use as collateral things that you would normally not consider to be kind of safe assets, if you will, a treasury or mortgage-backed security. So there's a primary dealer credit facility that could also be rolled out in this same vein. And as far as quantitative easing goes, and as well as Chair Powell's stated commitment, we can ramp up the money printing, if that's what you're talking about, beyond $150, $200 billion a month. It wouldn't surprise me to see that happen, given they did $37 billion of quantitative easing on one Friday afternoon last week. So I think the Fed stands ready to go as big as it needs to go in terms of a permanent quantitative easing type of balance sheet growth announcement. $37 billion on a Saturday afternoon, $700 billion on a Sunday night. I think the Fed's prepared to do whatever it takes.
Okay, we'll be watching to see if those additional levers are pulled. Danielle DiMartino, Booth, always good to talk to you.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.